Hello, dividend growth stock investors. It is Colby, the DGI Crab. Happy Sunday to you. Glad to have you in for another week as we get ready to prepare for the coming investing week. It's always good to have a plan in mind for where you are going to allocate that new capital as you try to acquire that sweet, sweet passive income. For anyone who is new to the channel, this channel focuses on just 60 high-quality blue-chip dividend growth stocks with long track records of increasing their stable dividends. But 60 is a lot of stocks to keep track of for an individual investor, so I split those into 4 separate categories based on the age and time horizon of the investor, which I believe is the most important metric for any dividend growth stock investor to take into consideration. And today, as I go through each of the tiers and look at where the value lies in the markets for the coming week, I want to take some time to also discuss why I buy what I buy and why you should be buying what you're buying as well. So I do want to just say I'm not a licensed professional financial advisor. The content of the channel should be considered primarily for entertainment purposes. I'm simply sharing my strategy with you, and my strategy looks just like the following. For my weekly investment dollars, half of that goes into age-appropriate dividend growth ETFs. So I have automatic diversification, and I'm not going to worry that much about how much allocation I have toward any individual single stock because I've got my diversification covered on the ETF side. Now, for me personally, I'm a value-based investor, so I'm looking to buy individual single stocks only when they are yielding 30% or more above the 4-year average yield. I do have a personal top 10 favorite stock lists where sometimes I'll just make a purchase for one of those 10 stocks, even if the value doesn't look amazing, because I do want to make sure that I have strong positions in my personal top 10. And I remain within my tier, my age grouping of stocks, unless there's one in a different tier that's yielding 50% or more above the 4-year average yield. And at that point, it's just too good of a value, too much yield to pass up for what it typically would be yielding, and also potentially a lot of opportunity for share price appreciation. And then I will just add more to my ETFs in any given week if I don't like any of the values in the individual single stocks. All right, guys, so let's jump into the spreadsheet next, where we're going to look at each of those 4 tiers. This is tier 1, you guys, and this is the group of stocks that I've got selected for the 18 to 30-year-old crowd. This group of stocks is not high yielding to start off with. We're usually looking on average, just as a group, probably like a 1.5% starting yield, which isn't super exciting for the young investors. I know that they want to start getting dividend yield now, but the magic of these stocks is the growth aspect of them. We're getting year over year dividend increases, dividend growth well above 10%. And this is going to give us a dividend snowball the longer that we are in the market. And when you're 30 and younger, you got a lot of time in the market. Sorted by the valuation metric, this is taking into account the current day yield and comparing it to the 4-year average yield to see how far off those numbers are. United Health, of course, remains the most undervalued stock, not only in tier 1, but of all 60 stocks of the channel's focus. Nike and Nordson continue to remain in the buy zone for the tier 1 investors as well. Tier 2, so this group of folks, age 31 to 41, they're getting higher starting yield at this point in time. Hopefully, in your younger years, you built up some of that stuff like Nordson, like Visa, like Microsoft, where you're going to get a lot of dividend growth. And now when you get into tier 2, you can just, for the most part, set that tier 1 stuff off to the side. I don't sell any of the stocks when they look like they're overvalued, or when I get into a new tier. I'm still, even though I'm in tier 2, about to graduate into tier 3 later this year, I'm not selling any of my Visa or Waste Management or Parker Hannifin. The positions that I have in all of these, I'm just letting the dividends reinvest. whether or not they look overvalued, whether or not they're in my age tier, because I want those positions to continue to grow and compound at least until I reach that point of financial freedom. In tier two, we've got Target, AWR, Hershey, and McCormick, all squarely in that buy zone. It is nice to see Hershey finally showing some signs of price recovery. Still happy to buy Hershey even at 184. Was getting it down in the 160s for the last couple of months, which was just amazing. But I've built up a really nice Hershey position now, and I'm not stopping. It's going to have to get up into that $100.90 range. $190 range before I'm going to pump the brakes there. AWR, McCormick, two super duper steady dividend growth stocks. Not stocks that are discussed a whole lot. They're not super exciting, but let's look at these. And if you consider yourself, a tier two investor, you're in your 30s, you're trying to build up that passive income, getting AWR. If we go in here to Seeking Alpha and just take a quick look here at the dividends tab, you can see AWR has this incredible consecutive dividend increase streak history, 69 years in a row. It's what it's probably most well known for as a stock, but a current day yield of 2.66%. Just shy of a 9% 5-year growth rate on that dividend yield. And if we go back here to the dividend growth tab, this is always just a nice way to remind yourself, you guys, about the history of some of these stocks, or if you're researching some other dividend growth stocks to see if they meet your criteria. You can see what their history is very quickly and easily here on Seeking Alpha. And I look here at their annual dividend payout growth year over year, and look how stable and consistent this is. It's not 20% one year and then 2% another. It's just a lot of 8, 9, maybe a 6 or a 5 once in a while, but incredibly consistent over the last decade. They had a stretch in the early 2000s, as you can see here, where the dividend growth was pretty slow, but this is a really stable utility that just did a dividend increase again for this year in that 8% range. So certainly starting yield mid twos, dividend growth high single digits. That's a model of what we want in tier two. This is going to perform really well for those people in their 30s with that combination of a little bit higher starting yield in the mid twos, but the really stable growth. Tier three, the 42 to 53-year-old investors, I'll be in tier three here in just a few short months now. Your tier three stocks, a little bit higher yielding than the tier two stuff, not quite as fast of dividend growth, but very, very stable, sleep well at night companies like Johnson & Johnson, Procter & Gamble, and Pepsi. Hormel, Pepsi, ADM, all remain viable. Archer Daniels Midland for quite a while was yielding up above 4%. They're showing some signs of recovery finally. They're going to be out of the buy zone if they get too much more expensive, but I could definitely still stomach adding more ADM at 57.84, getting a starting yield of 3.53 for your average yield of 2.66. So pretty nice value there still, but Pepsi absolutely remains my favorite buy in this particular tier 3 category. And Hormel's been flat for so long, you guys, but when that yield gets up north of 4%, I still feel pretty good about Hormel. Let's remind ourselves here why we buy Hormel, why Hormel's been in my buy zone for such a long time now. When a stock's been trading kind of down and flat for a while, you've got to just remind yourself what it is you like about Hormel. 58 consecutive years of dividend growth, currently yielding 4%. Our payout ratio here at 76% is starting to creep a bit high, but they've been in this position before over the past 58 years. I think they're going to be able to get through this okay. The 5-year dividend growth rate of 4.9% is pretty solid, but if we go into that dividend growth tab, they've been down for a little while right now. They used to grow that dividend even more aggressively. Last year was a pretty modest increase of 2.7%, and I think that probably is what we're going to see out of Hormel again this year, to be perfectly honest. But 5 and 6% the 3 years before that, and then just a bunch of double-digit dividend increases for all throughout the 2010s, where it really looked more like almost a tier one level stock, where the yield was a lot lower, the growth rate was a lot higher. And then you go back into the 90s and it looked a little bit more like it does today, where the starting yield's more in that 3 range along with the growth. So Hormel's just going to go through some cycles, and that's going to happen with the, your consumer goods, just depending on what's going on in the markets, inflation, uh, the prices of different goods. Hormel right now just in kind of a down cycle, but you can see why I like them so much. That dividend growth history is amazing. And if you can start out getting a yield above 4% like you can right now, that's pretty solid. Even if you have to suffer through a couple years of slow growth, eventually if they get back to a more positive cycle like you saw in the 20 teens where they're doing double digit dividend increases, and you started at the 4% range, your yield on cost will start going up really, really fast, which is amazing to see. Tier 4, 54 and older investors. So this group, we're trying to get 5% or better starting yield. If you're still adding stocks actively to your portfolio to reach financial freedom at age 54 and older, we don't really have time to add that slow or that low yield, fast growth stuff. We got to just kind of jump in there and get the yield now. Nothing in this group looks all that appealing, but Essex Properties has now, for a couple of weeks, held the top undervalued position as opposed to Realty Income or NNN REIT. But the three real estate plays in this category are the three that are on the top right now. Prudential's starting to look a little bit more appealing. I'd like them to get a bit cheaper, but certainly a very nice stock, yielding well above 5%. If I could get that more in the 6% range, it would look a lot better. So the buying strategy for the week, you guys, kind of would look like this, depending again on your age range. If I'm in that tier 1 category, I'm adding this collection of ETFs. And I do, by the way, you guys, always link down in the videos below links to each of the 4 tiers so you can see a breakdown of why I picked all of the stocks that I did for each category. And then there's an ETF listing in there as well, why I picked the ETFs I picked for each of the categories. So if you want to see why I broke things down this way, there's certainly a lot of excellent content on the channel going deeper into the individual strategies. But as far as the stock allocations go, look, you guys, for tier 1, my order of attack would be United Health, super undervalued. I'm going to be hitting that one really hard in that 30 and younger range. I've got all the time in the world at age 30 and younger for United Health to recover. So this is a great time, I think, to load up on it while they're going through a rough stretch here. And then Pepsi and Nike to me would be the next up, followed by Nordson and Target. And the reason why it's broken down this way is I've got the stocks in my own tier, like UNH and Nike, that are very undervalued. And then I'm getting the stuff in the other tiers that match my buying criteria as well. Pepsi being one of my top 10 favorite stocks in the buy zone makes it a green light for every other tier. And then Target in tier 2 does remain still 50% off the 4-year average yield. So I'm allowing myself as a tier 1 investor to reach up and grab some higher 4% range yield with both Target and with Pepsi. And then for tier 2, I can do a lot of things in tier 2, but I definitely want to make sure I'm getting Pepsi, Target, Hershey, AWR, and McCormick to round out the purchases in my own tier. I want to get some Union Pacific because it's one of my top 10 favorite stocks, and it's undervalued enough here in tier 2. It's about 11, 12% off the 4-year average. So I'm going to go ahead and add a little bit more here. I did a little bit just this week myself. UNH and Nike down there in tier 1 being very undervalued, of course. And then for tier 3, Pepsi, ADM, Hormel, Procter & Gamble are the top priorities. Target, UNH, and Nike are as well. And I could even see continuing to add to UNH in the tier 4 category as well if you were looking to add something that had a little bit more growth potential. That 3.5% starting yield's not bad. So that's the video for the week, you guys. Keep investing, and I'll see you next time.